Hello again, everybody. Welcome back to Accounting 1101, where we have come to the end of our journey in dealing with receivables. Got to pause for that because we've come a long way. How far have we come exactly? Well, up to now, we've been through what is a receivable. We've talked about different types of receivables that we have. We've talked about uncollectible receivables, and we've talked about different ways to account for an uncollectible receivable. So we've covered quite a bit of ground, and we got one more area to cover. And we're going to do that right now. How do we estimate the uncollectible amount? In our video before, I just gave you an amount, $30,000 estimated uncollectible. In reality, that number has to be calculated. In our video today, we're going to show you how to calculate it. We got two different ways that we're going to learn. But from last time, just a quick review here. Under the allowance method of accounting for an uncollectible account receivable, we recognize bad debt expense by estimating the uncollectible accounts receivable and then making an adjusting entry. The estimate can be based on past experience, industry averages, forecasts to consider future conditions, any of it. But that's the idea. Under the allowance method, we kind of estimate the bad debt. We got two different ways we can do it. We can use a percentage of sales method, or we can analyze accounts receivable and come up with the estimate that way. Under the percentage of sales method, we're taking an income statement approach. We're going to look at credit sales and we're going to estimate a percentage that won't be collected. We calculate the percentage uncollectible and then record it directly to bad debt expense and the allowance for doubtful accounts. Okay, so under that percentage of sales method, it's an income statement approach. We're making the calculation based off an income statement number. Sales, specifically credit sales. And whatever number we calculate, that's the number we plug into bad debt expense. That's why we call it an income statement approach, because we're using an income statement number and then we're plugging it right into bad debt expense, whatever we calculate. That's probably the easier of the two methodologies. Under an analysis of account receivable, we call that a balance sheet approach. Under that method, we calculate what the allowance account should be and then adjust the number to get to it. And so we'll show you that briefly and kind of put in some numbers and hopefully make a little bit of sense of that one. But first, our percentage of sales method. We're on DPS Company using that as our example. And as of December 31, they had a balance in AR of $240,000. They had a balance in the allowance for doubtful accounts of $3,250 on the credit side. They had total credit sales of $3 million. And they had an estimated bad debt as a percent of credit sales of 0.75%. So, if we're going to do percentage of sales method, it's pretty simple. We're going to calculate the estimated bad debt by taking credit sales, $3 million, times our bad debt as a percent of credit sales, which is 0.75%. So $3 million times 0.75%. If you want to do the math, go ahead and take a stab at it and see if you can come up with the correct number. We'll pause and give you a chance to do that. All right, so if you did the math, hopefully it checked out okay. $22,500 is what we come up with. And that's the amount that we would record directly to bad debt expense as a debit, and we'd also record it under the allowance for doubtful accounts as a credit. And so whatever we calculate using our percentage of sales method for estimating, that's what we record in our journal entry. That's what goes in the accounting records. From the financial statement framework, you can see we have basically decreased our retained earnings for that bad debt expense and also decreased our asset side for the allowance for doubtful accounts. So again, we threw in that $22,500 with no regard for what was already in the allowance for doubtful accounts. If you look back at our example, we had $3,250 in that allowance account already. We ignored it completely. We just added more to it because under the percentage of sales method, whatever we calculate gets dumped in there. Okay, so now we have a $25,750 balance, and that allowance for doubtful accounts. The other methodology is the analysis of receivables. This is based on the assumption that the longer an account receivable is outstanding, the less likely it will be collected. And it makes common sense. If somebody has bought something on account and you give them 30 days to pay and it's day 5, you're probably not panicking too much about them paying. But if it's day 150, then you're probably thinking, there's a good chance that they may not pay. By day 360, you're probably pretty convinced that they're not going to pay. So the idea is the longer we're out from the original due date, the less likely the customer is going to pay us back. And we analyze all of the receivables based on that idea. And this can happen in a spreadsheet. Almost all accounting software has a report you can run that ages receivables for you, so you don't have to do a spreadsheet. But this is kind of showing you a spreadsheet here. We got the customer in column A, their balance right there, and then you can see they got the not past due part, 0 to 29 days or whatever. This is the part that isn't past due. And then you have the days past due. 1 through 30, 31 through 60, 61 through 90, 91 through 180, and then 181 up to a year, and then anything over a year. And what we're doing is we're looking at the amounts owed and basically how long they've been outstanding. And as you can see down here at the bottom, where we've kind of totaled up all the columns, and we designated a percent uncollectible. You'll notice as we go further along, the longer it's outstanding, the more higher the likelihood is that they're not going to repay us until we get to 80% after it's been a year outstanding. Meaning that we estimate that 80% of people who haven't paid within a year aren't going to pay us back. So what we do in an aging of receivables is we break it down like that, and we get our total in every category, and then we just multiply it by the amount we expect won't be collected. And again, those percentages could be based on historical experience. They could be based on industry averages, all kinds of different things. So we multiply that out, and we get an estimate of uncollectible accounts based on how long they've been outstanding. We add all those together, we get 26,490. So when we do an aging of receivables, when we're using that analysis of receivables method, we're calculating what the allowance for doubtful accounts should be. The allowance for doubtful accounts needs to be 26,490. That's what we've calculated. So under the analysis of receivables, we have to think about what's already in that allowance account because we're calculating what it should be. That's why we call it a balance sheet approach. We're taking a calculation based on the balance sheet number. We're looking at receivables, estimating the uncollectibles based on a balance sheet account, and then we're tweaking a balance sheet account, the allowance for doubtful accounts. So it's a balance sheet approach. Our beginning amount, we have $32.50. We calculated we needed to have $26,490, so our adjustment is the difference between the two, $23,240. And that's why I said this is a little bit more difficult. Not that the calculation is difficult. The difficult part is we have to remember, I have to look in the allowance account to see what's already there. And then I got to make an adjustment that gets me to where I want to be, i.e. what I've calculated. So $23,240, that's the number we have to record. The entry is the same as it was in the percentage of sales method. We got bad debt expense debit and the allowance for doubtful accounts credit. You can see it reflected in the financial statement framework right there. We've reduced retained earnings for the bad debt expense, and we've reduced our assets for the allowance for doubtful accounts. When we compare the two methodologies here, again, percent of sales is an income statement method focused on an income statement account, bad debt expense. The analysis of receivables, our aging of accounts receivable, that's a balance sheet method focused on the allowance for doubtful accounts estimate. You get slightly different amounts here when you do the two. But that's kind of the idea. In reality, what a lot of companies will do is they will maybe do quarterly, percent of sales method every quarter, and then at the end of the year, do an aging of receivables and then tweak it. So they kind of do a mix-up of the two, and that's totally okay. So now we're at practice time. You've seen all the receivables videos. It's time to go back in, knock out a few homework problems. Give it a shot. If you have any questions, you run into any issues, let me know. We'll try to walk you through it. We have one more video for the chapter dealing with inventory. And so we'll see you back here for that one, hopefully. Everybody take care.